when I see an inverted yield curve, I generally think slower economic growth over the coming 12 months. That usually coincides with slower inflation because a lot of times it's recessionary and recessions tend to be deflationary in nature. But my takeaway wouldn't be like Goldilocks inflation is going down. It would be, inflation might be going down because economic growth is going to slow at the same time. But that's not a healthy dynamic for the performance of business assets.
It's funny because as somebody who dislikes the Fed as much as Jimmy and I do, I find no way to say anything positive about the economy without clapping for the Fed, like without giving them a pat on the back. Like if you're honestly like,
then give me a chance because I got some stuff.
Well,
Welcome to the Future Edge podcast. We have one of my favorite guys, Mike Singleton. Mike, tell him what your title is now.
It's still senior analyst and principal at Invictus Research.
Invictus Research. And one of our favorite guys, I get your newsletter every morning, by the way. I like the way you write quite a bit. It's usually, and I'm not just blowing smoke, I swear to God, it's usually one of the first things I click on to see what you wrote, because I just like your writing style quite a bit. So if anyone wants to sign up for it, right, you just go to Invictus Research.
Invictus-research.com. That's right. And thank you for the kind words.
Oh, no, it's not. These are not kind words. These are just facts.
Hey, Jimmy?
Yeah. Yes, Bob?
Real quick, I want to share a portion of yesterday's video newsletter before you start.
Cool.
Because when I reached out to Mike, he was kind enough to do this on short notice because he hit on a couple of points that I don't agree or disagree with. I just thought they were interesting as hell to kind of focus on.
First thing we're going to talk about is inventories. I was talking with another macro analyst, a very smart guy, who said that we are on the verge of a new goods cycle, new manufacturing cycle. And obviously I disagreed with this. He showed me this chart of retail inventories divided by retail sales. And he said, look, retail inventories are low relative to their 2018 peak. And therefore retailers will need to replenish inventory by purchasing more goods. This in turn will kickstart manufacturing. In my view, this is poor logic. First of all, if that argument were logical today, it would have been even more logical in March of 2021 when inventories were at a secular low relative to sales. That's when they bottomed. But in fact, the opposite happened. That's when manufacturing activity peaked. Second, the ratio of retail inventories to sales has been declining for the past several decades. You could have made the same argument for a new manufacturing cycle at any point since 1996 using the same logic. The reason or reasons it doesn't work is, one, this time series ignores the rest of the goods supply chain outside of retail, i.e. wholesalers and manufacturers. Two, it doesn't account for globalization and offshoring other parts of the supply chain. Three, it doesn't account for improvements in supply chain management and inventory management technologies, enabling firms to run with less overall inventory. And finally, it doesn't account for the gradual shift in consumption in the US from goods to services. All in all, in our view, this is a pretty useless time series. A better figure would be total business inventories divided by sales, although this has a lot of the same problems. That said, at least it does account for other parts of the goods supply chain. It incorporates retail inventories, but also wholesaler inventories and manufacturing inventories. And this ratio is high relative to history, 75th percentile. The other times we've seen it here were COVID, the industrial recession in 2015 and 16, the great financial crisis, and the dot-com recession. To view this information another way, total business inventories are about $215 billion above their 2016 to 2019 trend. If you account for idiosyncrasies in the auto supply chain, it's actually much higher than even that. In short, there is still way too much inventory floating around the US economy, and at Invictus, we do not expect a new manufacturing cycle given what we know now.
There's a lot there, right?
Why do you and I have to talk? Let's just have Mike do this whole thing and we'll take a nap.
Well, that's actually right where I was going to lead it, because I reached out to Mike and I said, it was actually yesterday, and I said, Mike, there's a couple things I want to talk about, and this specifically, because one of the things that I've paid close attention to in the short term has been inventories, and now I feel like I don't want to anymore. So can you go into where your thought process on this goes in terms of the business cycle?
Sure. So maybe I'll take a step back and talk about it from the perspective of housing and Fed policy first. So from a business cycle perspective, you could kind of start the clock with inflation running hot in early 2021. What does the Fed do when they see inflation running hot? Well, they raise interest rates, right? And as soon as they raise the Fed funds rate, pretty much every other constituent of the U.S. interest rate complex moves higher, including the 30-year fixed mortgage rate. As the 30-year fixed mortgage rate goes up, mortgage applications go down pretty much immediately. It impacts demand for new mortgage applications immediately because as mortgages become more expensive, people can't afford them, and so they stop applying. As demand for housing and new mortgage apps goes down on a little bit of a lag, maybe 3 to 6 months, that also impacts demand for durable goods, which are, of course, manufactured goods. So think furniture, home appliances like washing machines and dishwashers. Like I said, things that manufacturing companies manufacture, right? And so as new orders for manufactured goods decline, manufacturing companies cut production. And then, of course, you also have the inventory cycle that you have to consider as well. And that's kind of a simple dynamic to analyze. When companies have too much inventory, when retailers have too much inventory, when wholesalers have too much inventory, when the manufacturing companies themselves have too much inventory, those are all headwinds to production, because why would you produce more when you already have more than you can sell? And so just what I've heard recently is we're going to see a new inventory cycle. We're going to see a new manufacturing cycle. It's something that I think a lot about. I haven't seen any good evidence to that effect. Everything that I look at, it looks like, particularly in the goods space, which is where inventory tends to matter, there's too much inventory. There's too much inventory pretty much everywhere except for autos, which is something that I called out in the video. Given that the housing market is still pretty much completely locked up, especially if you look at total home sales, which is really the number to look at, and then rates remain high. So there's not going to be any policy relief, at least none that I see in the near term. And inventories are really, really high. I don't know why we would expect to see a new manufacturing cycle. And then back up just a second, again, big picture, why do we care about the manufacturing cycle? Why do we care about the PMI data or the production data? Well, it tends to correlate very closely with the performance of the stock market, right? So most durable bull markets, you'll see a manufacturing upswing at the same time. And through almost all bear markets, you're going to see a manufacturing pullback. Right now, there's actually a pretty considerable divergence between the performance of risky assets like stocks or credit and the performance of the manufacturing economy. But as a general rule, manufacturing and the performance of risk assets tend to go together.
So the second thing that I wanted to bring up then is, well, you kind of mentioned it, but you also brought up the shelter component of CPI. And rather than play another clip, I'll kind of let you speak to it, because that's one of the things that I've been noticing from a perspective. I live in Southwest Florida now, and housing prices are climbing back up. Honestly, had they not climbed as much as they did post-COVID, I would think this was kind of a rapid ascent, to be honest, in prices, because they've gone up quickly without giving any specific examples. So what do you see in the shelter component of CPI that might change people's minds about overall CPI?
So I'll caveat this by saying shelter tends to be such a lagging indicator within the inflation cycle that if there's a recession, you can more or less forget about this conversation. And usually if you're looking at the tail end of an economic cycle, forecasting out housing inflation is less important. It has less import in terms of how you might allocate capital, just because it tends to be so late. That said, if you're looking to forecast shelter inflation, if you're looking to forecast rent of primary residence or owner's equivalent rent, the primary input that most people use is the Case-Shiller home price data, because it tends to lead those time series by about 9 months. And so if you were to just run a simple regression forecasting out the CPI shelter component and the Case-Shiller data, it suggests that we should go from 8 or 9% rental inflation today down to about 3% in the beginning, call it Q1 or Q2 of 2024. So you would think, given that housing is, 40% of core inflation and services inflation, that should be a strong downward pressure on sort of these wage sensitive measures of inflation that have remained so sticky. That said, I think you could make a pretty good case that it doesn't really matter what happens with housing. What matters is what happens with wages. The logic being, if consumers do see some sort of relief in terms of rental inflation, consumers in the US don't really save that much money anyway, right? Between 5 and 10%. Recently, it's been much lower than that, sub 5% if you just look at the last couple of years. So, rental inflation is abating a little bit. Well, it doesn't matter, because they're going to use that money and they're going to buy other goods and services. And so you'll see the inflation from housing just flow through into other parts of the economy, maybe restaurant spending or something like that. And so the result is that wage sensitive inflation will remain in the 4 or 5 or even 6% range. Although, again, if the labor market gives out in the next 6 months or so, which is kind of our base case at Invictus, this whole conversation about housing is kind of moot.
You mentioned housing, and this is something that I think is very, very interesting, and I want you to tell me if it's as important as I think it could be. We've never seen, at least I've never seen, mortgage rates go up with the rapidity that they did, from 2.5% to 7.5% in a matter of call it 9 months. To me, it seemed like all of a sudden, because you mentioned the straight line efficacy of feeling interest rate hikes on mortgages quickly, and probably the single thing that's affected the most, besides maybe cars as well as in that group. Is there a case to be made that because they went up so quickly this time, it actually is choking supply because people who were thinking about selling do not want to part ways with that 2.5% mortgage?
I think that's 100% correct. So when you look at the housing market, there's a lot of confusion in the housing market right now because on the one hand, rates are really, really high, mortgages are really, really unaffordable. If you look at the MBA Purchase Index, which is mortgage applications for new home purchases, which I view as kind of the purest look at demand, it's still down about 53% from its cycle high in early 2021. And you could make the case that it stabilized a little bit in the last 6 months, but still 53% off of its cycle high. Demand is very, very tepid for new homes right now as a result of rates being so high. Nevertheless, you're seeing some housing statistics start to resurge, right? If you look at the NAHB index, which is a measure of home builder sentiment, it's gone up. I can't remember. I think since October or November, but it's seen a bounce for sure, right? If you look at new home sales, they're within a hair's breadth of a 12-month high. So you think, well, maybe we're in a new housing cycle. Maybe this is the beginning of a new cycle. Maybe this could start to stir a new manufacturing cycle. I think all of that's probably incorrect because when you think about what really drives the good cycle or even the housing cycle, it's total home sales. It's not new home sales. And total home sales is 80% existing home sales, or really more like 85%, and only 15% new home sales. And right now, there's no inventory, absolutely no inventory of existing homes because people don't want to give up their 3.5% mortgage. I think that the most recent statistic that I read was that 80% of current homeowners have locked in a mortgage rate below 4%. And I think the prospect of selling your home and selling the mortgage along with that home and then having to buy a new home at a 7% mortgage is not very appealing. And so this is just a long way of saying that the housing market is not very healthy right now. And if you're looking at statistics like new home sales or like the NAHB index and thinking that they're presaging some sort of economic recovery, I think what you're missing is that the supply situation is extremely unhealthy. And just as a cherry on top, if you look at total active listings since the great financial crisis, they're down about 75%. There's 75% fewer active listings in the US right now than there were in 2007, I think it was. And that's against a backdrop of a population that's 15% larger today. In other words, 15% more people looking for shelter. So not a healthy housing market.
Mike, do you think that dynamic can flip between new homes and existing homes? I mean, I'm actually just looking at like the performance of the home builders lately. Now, obviously, we know the home builders, and Jimmy can't legally comment on stocks. So, Jimmy, if you want to comment in a general way here, please feel free. But you're talking about similar performance, a little bit better performance recently, at least from maybe the beginning of July, from KB Homes than Pulte. Pulte had huge earnings blowout today. Is that the kind of dynamic that can switch, or is it way too large of an advantage in terms of existing home sales? I mean, obviously, companies like Pulte and KB Homes and these other large home builders do self-financing, they do discounts, they do all kinds of things to kind of offset the mortgage rates, right? Is that a dynamic, that 85-15, that can shift, or is it just way too much of a lead for existing home sales?
So it is shifting, right? Because there's no supply of existing homes on the market right now, because rates are so high, incremental housing activity is getting pushed into new homes, right? Which is why you are seeing new home sales trending higher again. Can it go from 15% to 20%? Probably. Will it go from 15% to 30%? I don't think so. And moreover, I don't know that home builders are incentivized to bring that much new supply online. When I look at the housing supply chain, I think that they're bringing inventory online in a very measured way. And that's probably because they benefit from this supply situation. I don't think they have any incentive to flood the market with inventory.
One hand, you mentioned supply being low, and that's probably supporting prices. And then in the same thing, you described it as being an unhealthy housing market. Can you shed some light on it? Because to me, and I guess maybe I'm just thinking too much of price, and you were thinking of actual availability of homes and shelter for real people. Now, because doesn't it seem to be very supportive of the housing market, the situation you entail?
Right. So from the perspective of a homeowner, very low supply is a price tailwind. It's a good thing for you as the homeowner.
Got it.
I'm thinking it from the perspective of the business cycle. The reason we care about housing or total home sales is because it's a leading indicator for goods, which is in turn a leading indicator for the broader economy. So total home sales are still 37% off of their cycle peak. Again, they've stabilized a little bit in the last 6 months or so, but again, still within a hair's breadth of the new cycle low. So there's no reason we would expect to see industrial production kicking back up in response to more demand for durable goods in response to a housing recovery, because there's no housing recovery, not yet.
So is this kind of a weird time, Mike, then? And I don't know if you've done any research on this or not, but when I look back to, say, 2009, 2010, 2011, when home prices were going through the roof, people started losing jobs. It wasn't a huge number, but they started losing jobs. Their wages were stagnant, but their homes were increasing at such a rate that they felt rich. So they saved even less than normal. So can that effect happen here as well? Have you ever looked at anything like that, or do you see any evidence of that? Where, I mean, your home, Jimmy mentioned, it's good for existing homeowners. They're not going to change out because the rate they have to get is too high. So they're just sitting there in their minds getting richer, whether the wages continue to increase or not.
That's an interesting question. So I guess the question is, could the wealth effect from your home price increasing?
That's the wealth effect for most people, right? Is their
right in value. I mean, I guess the transmission mechanism would be through home equity lines of credit, right? My home price is increasing in value. I'm going to monetize that, and then I'm going to go spend it on stuff. I haven't done any studies on that myself. I know that there's some academic work showing that the wealth effect tends to be more potent through housing than through stocks, which is interesting, but I haven't done a project on that myself.
I will expect you to credit this show if you do, so go ahead.
Right. Let's just say, I guess maybe there is some evidence for it, but maybe I'm not the best person to speak to it.
So let's switch gears, but it's not a complete gear switch, because I want to talk about money supply. I was just doing some thumbnail on it today, and by my estimation, that even if we stayed on trend from 2011, which was a dramatically high trend in the increase of M2 money supply, even if we stayed on that trend and you add in the $7 trillion that was injected in response to the pandemic, $2 trillion of that would have been anyway if we just stayed on trend. And of the extra 5 million, 2.5 has been dialed back, essentially. It's decreased by almost 5%. There's still $2.5 extra trillion sloshing around in the market on there. Is that why we're seeing stock prices doing so well, housing prices doing much better than any of the three of us assumed they would if you told us that mortgage rates were going to triple?
So are you talking about like M2, or are you talking about?
Yeah, let's go with M2.
So M2, personally, I see a little bit less of a straight line between the quantity of M2 and, say, asset prices. I mean, I know you can make logical deductions from here to there, but it's a little bit less obvious for me, or it's a little bit harder for me to articulate it. I don't think that the consumer savings situation is particularly good. I've heard a lot of people throw out numbers like $2.5 trillion in terms of excess savings, right? Like, oh, the consumer, the U.S. consumer has about $2.5 trillion of excess savings residual from all of the stimulus in 2020 and 2021. By my work, we're at less than 10% of that. Maybe we're at 200 billion or 150 billion right now. And we see that rolling down to zero in the next 4 months. And the Federal Reserve actually released a study in the last, I think, 6 weeks that said they thought now that excess savings was already zero. I guess that maybe leaves with the question, so what's going on with the stock market right now? That is a good question. It can tell you it's not really consistent with most of the fundamentals that I look at, right? Most measures of growth, at least I think I track every measure of growth. I can't think of a measure of growth that is super important that's really inflecting upward. I think that the economic fundamentals don't look great at all. And even the liquidity fundamentals don't look great either, right? The Fed is still tightening. The policy backdrop is still pretty restrictive. The yield curve is still deeply inverted. If the Fed's still running $85 billion or so of QT a month, the Treasury General account has largely been refilling out of the reverse repo facility, but it could certainly come out of bank reserves over the next 6 months or 12 months. It's not out of the question at all. I'm inclined to say, when I look at the markets and what's going on right now, and I know this is a horrible cop-out, but it looks like particularly the price action and large cap tech and anything with tangential exposure to artificial intelligence looks a lot like a bubble. What I mean by that is really just the price action is not explainable by the typical fundamentals that drive stocks as an asset class. And of course, there's also some similarities between what's going on right now and 1998, 1999, not least of which is that we've had a major technological development. I hope that doesn't sound like a cop-out, but I think that's as good
It's
next.
fun. But then here's the next question then, and this is one you can put a more definitive answer on. It sounds like I'm hearing Mike Singleton say that he believes the recession is absolutely coming. Is that a simplification of what you think?
Absolutely. I would put the odds at higher than most strategists on the street. I'd probably be a little wary to say 100%. I don't know if my work is that precise, but I think that it's 80%. It's higher than anyone else is talking about.
All right. Okay. So Bob, before quick question, I want to comment on one thing. Cullen Roche, Luke Roman. I've just read two things of them recently. Luke was talking about the inversion of the yield curve and talked about the Teamsters contract that they just negotiated where they got lucrative pay raises. And he made a very clear point. He said, if you look at the yield curve and you look at headlines like lucrative pay raises, then something's wrong. You know what I mean? Then if the yield curve is flashing that inflation is going away, which is actually what Cullen Roche said too. The yield curve isn't predicting recession. It's just saying that inflation is going away. Where do you fall on that?
I don't really understand the economic logic behind
so
that
what
trend.
I'm saying, what he's saying, I believe, is that if pay raises are happening, then inflation is sticking around, basically.
Jim Bianco says that too.
I think that when unions are negotiating large pay raises, that's generally symptomatic of a labor market that's tight and a labor market that's producing above trend wage growth. Right now, you could call it 4, 5, 6%, depending on where you're looking. So I think that everything that you're reading in the newspapers about strikes and the airlines and Hollywood and all of that, it's consistent with a 3.6% unemployment rate, right? And I think it's also consistent with a Fed that is very likely to remain hawkish at this next meeting. I don't know when this comes out, but my assumption going into tomorrow, the Fed meeting, is that Powell will be pretty hawkish. I think he has plenty of incentive to be hawkish. Another reason he has to be hawkish, besides the data, is just that he's not going to meet again until late September. He doesn't want financial conditions to ease unduly for the next 2 months. I'm inclined to think that as long as the unemployment rate remains sub 4% and productivity growth remains sub zero, you're likely to see wages and wage sensitive inflation running in the 4, 5, 5.5% range. I think that'll probably end whenever there's a recession, though. So you have to keep that in the back of your mind. I think that's probably, December, maybe January of 2024. Real quick on the yield curve too. I don't want to miss that. I've heard people saying that the inverted yield curve is symptomatic of a bond market that's simply discounting slower inflation. That's something I don't really understand. When I look at the data and run the back tests and whatnot, and what matters to the bond market and the yield curve, what I see is that the front end of the yield curve, short rates tend to trade virtually 100% on expectations about policy. The Fed pretty much completely controls short rates. When I look at the long end, it's about 80% policy expectations and 20% growth expectations, right? So policy is still really, really important, but growth sort of covers the delta there. And so when you look at the yield curve, you cancel out the difference in policy expectations and you kind of just get a more pure look at what the bond market is expecting in terms of future growth, which is why the yield curve tends to lead recessions, right? And it tends to have a positive forward correlation with different measures of the growth cycle. So when I see an inverted yield curve, I generally think slower economic growth over the coming 12 months. That usually coincides with slower inflation because a lot of times it's recessionary and recessions tend to be deflationary in nature. But my takeaway wouldn't be like Goldilocks inflation is going down. It would be, inflation might be going down because economic growth is going to slow at the same time. But that's not a healthy dynamic for the performance of business assets.
It's funny because as somebody who dislikes the Fed as much as Jimmy and I do, I find no way to say anything positive about the economy without clapping for the Fed, like without giving them a pat on the back. Like if you're honestly like,
then give me a chance because I got some stuff.
Well, people are saying there's going to be a soft landing. Well, they've only engineered one of them, and I forget if it was 94 or 96. And I don't even know they engineered that one in particular because literally 4 years later, we had one of the worst downturns we've ever had, 2000. But you look, and actually that's kind of what this reminds me of, because what I was telling people about a year and a half, 2 years ago is I thought we were going to have a fairly shallow recession sometime in early 2023, which I was wrong about the timing. And then the next one we had after that was going to be really, really bad. And I said that was going to be like 2025, 2026, possibly even further out than that, because I do have, and I want you to tell me where I'm crazy here, Mike, if you do think I'm crazy. I do think that the Fed will hold rates. I think this Fed under Jerome Powell has done what they've said they're going to do, even if it's been wrong. All the way back to when they said inflation is transitory. They didn't touch rates because they thought it was transitory. Then we had Jackson Hole where he was all freaking Rambo, right? And all of a sudden they just started hiking rates at an unprecedented rate. And now they're saying we're going to possibly hike rates again after July. And it's interesting, that long lag between this meeting and the next meeting, right? Where all this data can come through and they have plenty of time to say, by the way, we're not going to. People look at the dot plots and they go, well, the dot plots are here. Man, those dot plots, they should be on your top 3 things. It doesn't matter one of these days. It's like those things, it's just a projection. And then the next time they change their projection.
It's not even a good projection. They're not good at this.
They're terrible at this.
Right.
So I that's part of the reason that I like discount all this stuff, is because I don't think the Fed is any good at this. And if we end up with a low inflation soft landing, then that means they were good at this one. Is that just petty? So you could say yes.
I think that's just sort of a late cycle. I just think that's sort of a late cycle phenomenon, right? Is that it always kind of looks like there's a soft landing as inflation comes down off of the peak, right? And you don't have the labor market really budging yet. And so that always looks like a soft landing. That's what a soft landing is, right? Inflation coming down without the labor market giving out. My take on that would be that the cycle's not over yet, and it's probably premature to call it a soft landing. So I don't know. I'd give it another 6 months.
All right, I have a question based on something you've actually written,
Good.
okay, so that we don't just keep putting you on the spot. I'm going to put something else on the screen again if I could. This was from this morning.
Oh, in the meantime, I could have got him a comment while you're putting it up.
Yeah,
Is there a less than 0 chance of a rate ease in the 8 weeks between these next 2 meetings?
Oof. I would put it very low. Something
Well,
pretty
how low?
would have to happen.
5%?
Yeah, 1%.
Okay.
You
I
think
think it's 5%.
You think it's higher than that? Yeah. So what's your rationale for that? I'm curious.
No, we saw the whisper of things happening in the bank portfolios. I just don't think we know where the punch is coming from. Rates have gone up so fast. We know that there's a long and variable lag effect. We don't know when things are going to hit and start to crumble. Again, I said 5%, by the way. So, I didn't say 80%. So I think that, we've been punched out of left field before. And I think it's quite possible. But again,
for those of you that aren't seeing this, this is from US PMI report from yesterday, which is the 24th. That's the S&P Global PMI. Go ahead, Mike. And then I want you to go into, then I'm going to have a question on this, which is weird.
Sure. So the first quote says, despite a slower contraction in new sales, manufacturers registered further decreases in input buying and holdings of both pre- and post-production inventories in July. Firms sought to trim stocks further and engage in cost-cutting efforts amid muted domestic and international demand conditions. Growth is being driven entirely by the services sector, which is helping offset a becalmed manufacturing sector and increasingly subdued demand from U.S. households and businesses. The darkening picture adds downside risk to output growth in the coming months, which will keep alive fear that the U.S. economy may yet succumb to another downturn before the year is out.
Okay, so my question, again, this is from your report on the 25th. My question is, the US PMI report said that growth is basically coming almost entirely from the services sector, and that's where inflation has been the most stubborn. Can that sector pull the manufacturing sector up, even though it hasn't done it historically in your research?
It could certainly help the economy remain resilient. But I sort of think that to have 20% of, I don't think it's possible for 20% of the economy to just not work and to sustain the quality of life and living standards that normal people expect. So I would be inclined to say no. I think it's also a question of how long manufacturing companies are happy to see their margins decay, right? And I think a normal expectation would probably be that a company will lay people off before it'll let its margins go negative, or decline beyond a certain point. The longer the 30-year fixed mortgage rate is near 7%, the longer the Fed funds rate is 5%, 5.5%, whatever, the longer the housing market will remain stagnant, the longer demand for goods will remain stagnant, the longer margins for manufacturing companies will remain low, depressed, declining. And I think that it's only a matter of time before they start to lay people off. And actually, if you look at the manufacturing employment data from the BLS or from ADP, it's actually already showing pretty significant signs of weakness, particularly the ADP data. I'm going to mess up the numbers off the top of my head, but I think the last report for June was something like 40,000 net layoffs, according to ADP. And if you look at the last 4 months, it's something like, maybe it's 6 months, it's something like 160,000 net layoffs. So you're already seeing manufacturing companies watch their margins decline. You're already seeing them start to lay people off. It's really just a question of the extent to which it'll metastasize. And the longer that housing remains down 37% off of its peak or whatever, real retail sales of durable goods remain 15, 20% plus off of their cycle trend from post the great financial crisis, the more they're going to have to lay people off. They can't run a business with no demand.
I have a question about volatility, and options volatility particularly. And now I'm going to bring this back to stock market and what any of us expect in the next couple of months. The last three big stock market breaks, huge VIX spikes, have come off of very depressed levels, much like we are now. Like, I know some people look at a 13, 14 VIX and be like, oh, the options market is telling us there's nothing to worry about, so there's nothing to worry about. I look at it the opposite way. I think that it reflects complacency, and from complacency is when these huge plunges happen. Have you done any work on what us ignoring risk? The more we ignore it, does that make the big plunge more probable?
So I haven't done a ton of work with equity volatility or the VIX. I think clearly you can look at the VIX right now and you can just deduce that stocks are not pricing in anything but a soft landing. I think that's fair to say and sort of an easy deduction. You could also look at the equity risk premium or price to earnings ratio for the S&P 500, and you can see that it's pricing in very, very strong economic conditions because that's the only way that these valuations make sense. Maybe I'll flip your question a little bit and talk about credit spreads because it's another measure. You could think of it as like the VIX for the credit markets, right? Generally speaking, credit spreads trade with an inverse correlation to the growth cycle, to the manufacturing PMI, as does the VIX, by the way, but I'll stick with credit for just a second. Credit spreads are frequently a good leading indicator for credit events, I guess, for big market stress, for pullbacks in the S&P 500. That said, it's not perfect, and I'm sure that the VIX isn't perfect either. In fact, I know the VIX isn't perfect, but I don't have specific details. Right? If you looked before the great financial crisis, credit spreads weren't giving you a great signal, right? They were relatively low heading into the downturn in the economy. If you look at credit spreads right before COVID, they were very, very tight. They weren't giving you there were other leading indicators you could have looked at and saw that the economy wasn't functioning properly, especially if you were looking abroad, but credit spreads were not one of them. Credit spreads are certainly an important input into our process at Invictus. And I'm sure that the VIX, if you are good at analyzing it, could be an important input into your process. In my mind, this is just sort of evidence that it's good to have a holistic process that takes sort of a weight of the evidence approach and considers multiple different factors, because I haven't found an indicator yet that is, the batting average is 100%.
It's interesting because I think back to the tech bubble. 99, 2000. Jim, I don't know if you remember this. We're about the same age, but I think your brain is a little older than mine.
No doubt.
Which is a way of me saying I'm childish and you're, yeah, whatever. I just insulted myself. I hate when I do that. So
insulted us both at the same time. It's very efficient. Well
there's
played.
a compliment in there somewhere. You got to dig. You got to dig. In the tech bubble, nobody was buying puts. There was nobody buying puts. And I remember, because I was one of the guys Jimmy, do you remember Nitro?
Sure, yeah.
I don't think Nitro watches our show, and he's so big that I hope he doesn't. But I remember watching him leave the pit and come to my phone and go, do you mind if I call my broker? I got to sell out of my red hat. And a few minutes later, he'd come back and go, I want to buy some more red hat. Then he'd go back and he'd go, I want to sell out of my red hat. And he would just literally, at the end of the day, he would have missed 10 orders in the pit, but he made like $60,000 trading red hat, right? And I remember thinking, Nitro can't spell red hat, And again, I really hope he's not watching this. I don't think he knows where I live. He's a giant guy, Mike.
I got a funny story about him as soon as you're finished. Though,
go on. By the way, he's a fantastic guy. But I remember thinking, you just should buy red hat and sell some covered calls or buy puts. And it's like, and just buy puts in the NASDAQ. I mean, you didn't even have to do covered
cheap.
calls. Yeah, they were cheap until they weren't. And that's one of the things that scares me about this particular market in this moment. Not necessarily any of the bull markets we've been through recently. I'm not talking about post-COVID. Post-COVID, puts were expensive, right? And it wasn't even necessarily tied to the VIX. And that's something I'm worried if the VIX is a little bit broken. But looking at the fear side of it, I don't know if you look at any fear gauges outside of the VIX, but I don't see anyone afraid that anything colossal can happen. Like even when we had that regional bank scare, you see any signs of that in your research? Or are you just purely on the business cycle and thinking there's a new cycle approaching?
So I would say I definitely tend to be more business cycle oriented and a little bit less sentiment oriented. I personally find it quite challenging to find good sentiment data that produces a really reliable signal. I tend to like positioning data a little bit more when I can find it. So definitely less on the sentiment stuff. I also would add one more thing on credit spreads, because I was just looking at them earlier today. And if you look at the triple C spread, which is a spread that I like to look at because it's just the riskiest of the risky in terms of the high yield market, it's breaking down to new cycle lows. And generally, when credit spreads are contracting, forward returns for stocks tend to be pretty good, right? If they're going to go up, they probably need a little bit of time to sort of consolidate first. And so, there's a bunch of inputs into my process, and some are bullish and some are bearish. That's actually kind of a bullish input. And I would say it's evidence for the case that a recession might not be in the next 3 months. It might be in the next 5 months or 6 months or something like that, right? It's just one piece of evidence. But when you watch credit spreads continuing to contract and not just consolidate, in my mind, I think, well, you've got to give that one to the bulls.
That's interesting, because I look at the VIX, and again, when you brought up the credit spreads and the VIX, I think it's the same trade. It's just how we price risk, right?
Right.
That's interesting. The quick thing about Nitro, real quick, is he played in a bunch of preseason NFL games, but never actually made it to the NFL. And one day he's telling a bunch of stories to us at the desk, and he had a couple sacks. He was a defensive lineman, and I go, "What was the hardest hit you ever put on a quarterback?" He goes, "Man, this one time," he goes, "I remember it vividly. Troy Aikman, was rolling one way, he couldn't see me, and I just buried him." And I'm like, "Wow, that is so cool." And I was like, "Wait, weren't you on the Cowboys?" He goes, "Yeah, I was in practice. I got in huge trouble for that." I was like, you're a dumbass. But anyway, come on, Bobby, you got the next question? I was just thinking about Nitro's story.
Yeah. So the next question would be the actual business cycle turn. You're not big on predicting when it happens, right? You're just looking at markers. But do you have any indication as to when if we actually turn?
The turn that I would be looking at would be the turn in the labor market. And that's generally the catalyst for the quote unquote big sell off in stocks. Or when people use the phrase credit event, usually what they're referring to is unemployment rate goes up, incomes go down, and that causes credit problems. We do have models for modeling the unemployment rate. What they're saying right now is that the unemployment rate remains below 4% through 2023, right? And then climbs to upward of 7% by Q2 of 2024. So, 4% by December of this year is still up 40 basis points. So, people might be talking about the labor market starting to show some signs of easing in between now and the end of the year. But the real damage probably won't be until the first half of 2024. At least that's what our work suggests.
Mm-hmm.
Okay. That's interesting. And it kind of covers my question too. But when I look at the last couple unemployment numbers, and I look at the birth death model, which is terrible in market turns, and it's almost comical. So I got a laugh out of you just mentioning the birth death model. Government jobs were in the last one. If you make those things at more reasonable levels, can't I make the argument that the labor market has already begun to turn in earnest?
Well, I think it depends on exactly what you're looking at. I think that if you look at, the work week, if you look at cyclical jobs like residential construction and manufacturing, if you look at, the Kansas City labor market indicator, which is a very good project by the Fed that takes a lot of these indicators that we're talking about and uses principal components analysis to sort of distill them into a single time series. That's turning up. That's consistent with an unemployment rate of about 4.2% right now. And that's generally a pretty good indicator, right? Yeah, I think you could look at places in the labor market and say, clearly things are turning. I think the headline unemployment rate is the most important policy input for the Fed. And it also tends to be what the markets trade most on, or the initial claims data, if you will. So those are likewise things that we're focused on, because generally the thing that we care most about at Invictus is trying to get markets right. And so we look at the things that move the markets. But you're right. There are, beneath the surface, there's all kinds of problems happening with the labor market, but it's just not enough to move that headline number yet.
All right. So far we got that analyst who told you to look at inventories mad at us. We got Nitro mad at us. So let's go.
Sorry, Nitro. I love you, man.
I want to ask you is there an economic piece of data or a study or a survey or something that you hear people look at a lot or see a lot, put a lot of weight in, where you just want to shake them and be like, why are you looking at this? In other words, on your daily edge, you do 3 important things to look at, 3 things that don't matter. Is there something that consistently pops up in the 3 things that don't matter that you'd like to tell people? stop looking at this? Anything at all?
Off the top of my head, a lot of people this cycle, this is kind of the opposite of what you're asking, but there have been a lot of people questioning the credibility of the PMI data, which is data that I'm very biased about. I really like the PMI data. And they'll say, oh, it's just a diffusion index. Oh, it's constructed from survey responses. It's not hard data. Oh, they're only asking 500 different companies. What kind of sample size is that? And I think that's pretty, and they'll say, look at the hard data, look at the FRB industrial production data because it's based on accounting estimates. And, that's not really hard data either, but, there's been a lot of that this cycle. And I think the PMI data tends to have the closest correlation with stocks, credit, oil, the dollar. It's a great indicator. And the reason I care about it isn't because I love the way it's constructed. The reason that I care about it is because it best represents manufacturing activity, which in turn leads the growth cycle, and tradable risk exposures trade on top of it. And one more thing, it tends to lead the FRB industrial production data by about 4 months. So there's a period of time where people were saying, oh, the PMI data is wrong because it's going down and the FRB data is holding up. And then, of course, we just had the FRB data print negative 0.4% last month for June, right? So now they're like, oh, maybe there's manufacturing weakness after all. And if you were looking at the PMI data, you would have known that the whole time. And if you would have spent 10 seconds looking at the correlation, you would have seen that it's actually a leading indicator.
So you're the guy that doesn't care if the placebo cured your Lou Gehrig's disease. You're just happy you got cured.
Yeah, not particularly. Yeah, I want the indicator with the most information content about the economy. And if they're getting that information from reading playing cards, I could care less.
Before Jim asks his question, tell people what the FRB data is for people who don't know.
It's data on industrial production collected by the Federal Reserve Board. And rather than asking manufacturing companies, hey, are things getting better or worse, and then backing into a diffusion index, they use real data that they collect about sales and real measures of output like steel tonnage and stuff like that.
So you mentioned response type surveys. JOLTS, CPI and PPI are both surveys done. And responses from companies are falling. JOLTS data used to have 70% response rate even like 5 years ago, and now it has 30% response rate. CPI response rate has fallen to 54. Are you watching these kind of things and thinking, is this some sort of commentary on a greater like complacency, like the government sucks kind of thing? Why do I want to play ball with them? What do you make of it?
It's a good question. I'd say for all of the data that you just listed, maybe particularly the JOLTS data, I don't remember where I heard this, but I heard someone say that you should take it seriously, but not literally. I think that's generally a good way of framing it. The data tends to be, at least in my experience, directionally accurate and directionally consistent with other data that I look at that measure similar things. I wouldn't take the levels so literally. So for example, the job openings number has been very, very high post-COVID. Do I really think that there's X number of job openings as the JOLTS data describes? No, probably not. I think it's probably pumped up by multiple online listings and stuff like that. But I do take it seriously, right? And I especially consider it as a policy input because Chair Powell has mentioned the ratio of job openings to unemployed persons about 1,000 times. And so if he cares about it as a policy input, then I care about it as a policy input.
That's a brilliant answer, by the way, because the direction of it is what's important. And the fact, I'm just underscoring what you said, the fact that Powell thinks it's important makes it important. Sorry to interrupt you. Please go on. Yeah.
Right. 100%. And then in terms of the declining participation in terms of the surveys, maybe that's because companies are going through more challenging business conditions and they're focusing on their businesses instead of answering surveys from the Fed or from the BLS or whomever.
By the way, you said you used the expression off the top of my head before, and I can't help noticing your fantastic haircut. How much do you pay for a haircut like that? Is it expensive or not?
Did Bobby tell you?
Has it gone up?
No, I didn't, Mike. You don't know how much we talked about this before we
before
started
I came
recording.
on, even wow. Bobby and I maybe are both hair obsessed. Is it an expensive haircut? Just not.
No, I haven't had a haircut in like 8 weeks, and it's a very low quality camera I'm using off of my computer, so you can't tell. But it's a mess right now. I need to go to get a haircut tomorrow.
This is one thing I will disagree with you on. It is not a mess. That is fabulous hair.
Singleton is mostly Italian, Jimmy, so we did it again.
We did it again. So, Bobby, if you have a non-hair related question, Bobby, please shoot.
No, I'm all done. That's all I had for him today. I succumbed him to his own research, and he did well.
That's fantastic. Mike, I every time we talk to you, I think it's fantastic. I think you are a wealth of knowledge. And again, I will reiterate that I like the way you speak and I like the way you write. It's very, very to the point, and there's not a lot of fluff in it, and you get what you get. And I really like that, and I appreciate it. Thank you very much.
Oh, my pleasure. Thank you for having me.
Yeah, his morning video, there's more data in less than 15 minutes. I think 100% of the time it's less than 15 minutes.
Yeah, let's just boost Mike up. So he's the biggest person in media, and then we'll just work for him. Yeah. How's that go? That's what we'll do. We're going to make a star out of you, Mike.
That sounds good to me.
And we're not going to work much. That's on the record.
Oh, no, we'll be terrible employees. But since we built you up, I hope that we get, a little bit of a carve out.
Yeah, we'll do like a quarterly golf outing, and there'll be board fees, of course, that you guys will get.
Perfect. That's exactly what I'm looking for.